As interest rates rise and balance sheets tightens, not every funding option fits companies. That's where preference shares step in, bridging debt and equity. I'm Kashfia Bint Hassan, an analyst at Lion City Advisory. Under IAS 32, preference shares classification doesn't depend on the name, but on their substance, as in what they actually commit the issuer to do. There are two main types. Firstly, there's debt-type preference shares, and secondly, there's equity-type preference shares. Debt-type preference shares behaves a lot like a loan. They pay a fixed return, are redeemable at maturity, and create a contractual obligation for repayment. Because of that, they're treated as financial liabilities and payments are recorded as interest before tax. Secondly, there's equity-type preference shares, which is completely different. They're irredeemable and dividends are discretionary. Since there's no repayment obligation, they're classified as equity instruments. Dividends are paid after tax directly from profit and don't appear as expenses on the income statement. However, they come with a regulatory capital charge. Banks must hold risk-weighted assets between 20% and 125% on debt-type preference shares based on the credit rating of the issuer. For example, for a AAA rating company, the RWA is 20% and so on. At 125% risk-weighted assets are needed to be kept against equity preference share. Debt preference shares are not capital market instruments. However, equity preference shares, on the other hand, are. Now, why are preference shares so attractive in Bangladesh? There are four big reasons. Firstly, there's tax efficiency, as in, for banks, income from preference share is taxed at a final rate of only 20% compared to the usual 37.5% corporate tax. Secondly, there's no general provision, as in, unlike standard loans, they don't require a 1% general provision which frees up valuable capital. Thirdly, there's regulatory compliance. They maintain full CIB reporting and single borrower exposure compliance without being treated as traditional loans. And lastly, there's transparency. For listed companies, issuance is approved by the BSEC, ensuring investors' protection. In simple terms, debt-type preference shares are irredeemable, interest-bearing, and recorded before tax. Equity-type preference shares are irredeemable, dividend-based, and recorded after tax. Together, they allow corporates to raise long-term capital without adding debt while offering banks and investors stable return, tax benefit, and regulatory flexibility. At Lion City Advisory, we help clients structure preference share solutions that meet IAS 32 standards, comply with BSEC regulation, and deliver real strategic advantage. Because preference shares aren't just hybrid instruments, they're a smarter, more sustainable way to finance growth in today's market. Thank you so very much for watching. For any kind of queries, please feel free to contact us.